think we need, as far as regulation is concerned, everybody is criticizing regulatory capital rules for being pro-cyclical. But I think we need to learn to live with pro-cyclicality, because no one wants to go back to Basel I. As long as we have capital allocation techniques, whether regulatory capital or economic capital, which are risk sensitive, they're going to be pro-cyclical. And Basel III came up with this idea of constituting a cushion, a capital cushion that you constitute in good time, and which will allow you to absorb losses in bad time. But I think that the main risk, systemic risk, comes from counterparty credit risk. And if you look at the losses during the subprime crisis, 2/3 of the losses, were related to the mark-to-market of credit spread risk, right? They were not related to default, right? And one way to limit systemic risk associated with counterparty credit risk that we experienced with the fall of Lehman is to clear the trades that we can clear. You need to standardize as much as we can OTC product like swaps, CDS, that can easily be cleared in a clearinghouse. That will reduce quite dramatically systemic risk. I don't think that the way we manage risk has changed quite dramatically from since the beginning of the subprime crisis. What has changed is the layer of regulation. So now we have to implement new risk measures like stress testing, scenario analysis, and that's relatively we were doing that before, but we have additional regulatory requirement regarding the way of looking at risk. To come up with asset management strategy which incorporates risk control, you need to come up with a risk indicator, right? So you need to come up to build your own risk indicator, and in our case, we came up with a risk what we call an advanced risk perception indicator, which is a mixture of implied volatility. So they take the VIX, for the US market, credit spreads. We have the credit spread on this. We have credit indices like the CDX for the US. The CDX investment grade, CDX high yield, and the dynamics of the yield curve could be the slope of the yield curve, which anticipates a recovery on the economy. We take also a difference between, say, the 1-year rate and the moving average of these rates. So we have, and you could come up. I attended a presentation by Riskelia, and which does not the same thing, but in the spirit of what we are doing. They also came up with their own risk indicator, which is a mixture of many more factors. So you normalize everything and you come up with your index. Then the next step is, in our case, is to come up with a technique which allows you to identify risk regimes. And the idea is pretty simple. So you identify risk regime. For each regime, you calibrate investment strategy. And the whole idea, again, is simple in the sense that if you anticipate a high-risk regime, you'll be invested in money markets, right? And if you anticipate a low-risk regime, you'll be very aggressive in your allocation. You'll be invested in stocks, in emerging markets, commodities, name it. Okay. I think it's important that the regulation is implemented and is followed by independent body like the ECB. If governments are in charge of imposing regulation, there will be probably some temptation, you know, to be influenced by the lobby of the bank's lobby. So you need really a body which is independent from the government. In New York or in Chicago, we speak French on the trading floors. The French have really exported the French engineers. We have top-notch programs in mathematical finance, in finance in general. So I think that's what something we've, I mean, all the schools, whether engineering schools or business schools, have come up with excellent programs in finance. Of all the students coming out from these programs have have been appreciated not only by French institutions but also by foreign institutions, whether they are based in London or New York or Hong Kong, Tokyo. You find French financial engineers all over the world.